Welcome to the deep dive. Today we're plunging into a document that's really making waves already. It's the White House's landmark report on digital assets, just dropped today. Now, for you listening, you're already deep in this world, right? Development, trading, DeFi, investing. So, this isn't just another policy paper. People are calling it a potential roadmap, maybe even a turning point for crypto in the US.
Yeah, what's really striking, I think, is how it signals this shift. It feels like moving away from just sort of cautious experimentation
Yeah.
towards, real acceptance and adoption. It's a deliberate stance.
Exactly. And because you're already up to speed, we're skipping the 101. Our mission today is to really unpack the deeper implications. How does this hit the crypto native world? How does it ripple through TradFi? We want to spotlight the opportunities, flag the risks you need to watch, and, help you figure out where to focus your learning and investing. It's about getting you some actionable intelligence, finally, in this space that's been, well, pretty opaque.
It really is.
Yeah.
So I'm trying to bring some predictability, moving from just reacting to actually setting a course.
Okay, so let's unpack this. The first thing is this huge shift, it feels like, in the regulatory mood. We've lived through years of regulation by enforcement, maybe even that Operation Choke Point 2.0 vibe. But this report, it explicitly talks about being pro-innovation, pro-crypto, aiming for regulatory clarity, fostering free market participation.
And connecting that to the bigger picture, it's not just words, right? It feels like a really direct signal. The administration seems serious about clearing out those regulatory roadblocks.
Yeah.
They seem to want the U.S. to be the place for digital assets, and you see that reflected in some key personnel choices, too.
Yeah, that's where it gets really interesting. It's like they're reshuffling the deck. You've got the President's Working Group on Digital Assets, now led by David Sachs, the special advisor for AI and crypto. That group got marching orders, tight deadlines to recommend changes. And it's not just at the top, right? We're seeing signals from the key agencies, too.
Absolutely. Look at the names. Paul Atkins, known to be constructive on digital assets, is the pick for SEC chair. You've got acting SEC chair Marco Yida creating a crypto task force, led by Hester Pierce, no less. Acting CFTC chairwoman Pham is pushing digital asset roundtables focused on innovation. And acting FDIC chair Travis Hill, he's openly supporting tokenization, talking about an open-minded approach. These aren't random picks. It signals a direction.
And this next bit is, I think, absolutely crucial for anyone building or investing right now. We're seeing the government literally clear hurdles for traditional finance players. What's maybe the biggest barrier they just knocked down? The one that could really open the institutional floodgates?
That has to be the rescission of SE 121. The SEC replaced it with SE 122. SE 121 basically made crypto custody a nightmare for publicly traded banks because of the accounting. Now, SAB 122 says essentially that accounting for safekeeping crypto is like accounting for traditional assets. That's not just permission, it's the regulatory comfort they needed. It unlocks balance sheet treatment, potentially huge liquidity.
That's a genuine game changer for getting banks properly in the game. What else? Beyond the SEC.
Well, the FDIC pulled back its notification of engaging in crypto-related activities. They're now saying banks can do crypto, provided they manage the risks. It's an affirmation. And the OCC, they got rid of their supervisory non-objection requirement for things like custody, stablecoins, DLT payments. These aren't small tweaks. They remove real friction, making it easier for banks to serve crypto firms.
And the Fed, too, right. They pulled back some supervisory letters on crypto activities, stating their goal is to support innovation in the banking system. So, taken together, it's less about confrontation, more about integration. It feels like a new era.
It does. These rescissions are loud signals. They're serious about removing barriers, making the U.S. attractive. This directly creates paths for banking services and institutional money that were just too blocked or murky before.
Okay, so the administrative path seems clearer, but the report also really pushes for the next step, actual laws. What does this congressional urgency really mean for the rules of the road going forward?
Right, this is where we get into the nitty-gritty of the framework, especially for stablecoins and overall market structure. It's about turning that pro-innovation talk into, actual legislation.
Exactly. And stablecoins are clearly a huge focus, heavily influenced by Loomis Gillibrand, now called the Genius Act. For our listeners thinking about DeFi, payments, everything, what are the key takeaways there?
Okay, the Genius Act puts the Federal Reserve in charge of oversight for stablecoins. It says issuers need to be regulated banks, or if their balances are under $10 billion, state trust companies registered with the Fed. And crucially, for stability, 100% reserves, high-quality liquid assets, and importantly, no rehypothecation except for redemptions. You can't reuse that collateral.
That 100% reserve, no funny business rule, that's huge for preventing depegs, right? How does that affect, say, capital efficiency or competition from overseas issuers?
It's definitely a trade-off. It prioritizes safety and trust over maybe some of the more, let's say, creative DeFi stablecoin models. But for mainstream adoption, for cementing the dollar's role, that rock-solid backing is probably essential. The act also demands quick redemptions at par in cash within a day, and CFO signed reports on reserves under penalty of perjury.
And no FDIC insurance, but they're setting up an FDIC-run receivership process if an issuer fails, a safety net.
Exactly. And here's the real kicker for usability. Genius explicitly states that these licensed U.S. payment stablecoins are not securities and not commodities. That's massive. It paves the way for them to be used just like money for payments without all the regulatory baggage.
Okay, so that's stablecoins. What about the rest of the digital asset world? FIT21 is mentioned as a sort of blueprint.
Yeah, the Financial Innovation and Technology for the 21st Century Act, FIT21. The core idea is splitting oversight, SEC and CFTC, based on the asset's characteristics, like how decentralized it is. It even allows for an asset to maybe switch regulators as it matures, from security-like to commodity-like. The focus is on tech-neutral rules, clear jurisdiction, that's the predictability institutions crave. It also calls for regulating intermediaries, custodians, exchanges, brokers, bringing structure.
Which brings us to a really interesting, maybe even provocative part of the report, CBDCs. It feels like a very strong no thank you to a digital dollar from the government, but a big yes please to private sector innovation with stablecoins and tokenization. The report flat out discourages, opposes, even prohibits agencies from pushing CBDCs here or abroad.
Yeah, the no to CBDCs is pretty emphatic. It's not just about privacy worries, though those are mentioned, risk of government surveillance, control over finances. It seems like a strategic bet on private innovation to boost the dollar globally, maybe more effectively than a government-run digital currency could. They cite risks to financial stability, too. And remember, the Anti-CBDC Surveillance State Act actually passed the House just last month.
Wow, okay, so a very firm line. And contrasting that, they're actively promoting dollar-backed stablecoins worldwide. How does this policy choice play out for payments innovation for our listeners focused on efficiency?
It's significant. DLT, especially through stablecoins, promises to slash costs and delays. Think cross-border payments. Right now, sending $200 internationally costs, what, over 6%? And takes days. Stablecoins offer instant settlement, much lower fees, easier ways to move between fiat and crypto, especially for local currencies globally.
And this isn't just talk anymore, is it? Institutions are moving. Banks exploring tokenized deposits, working together on stablecoins, and tokenized real-world assets, RWAs. That seems to be really picking up steam. Estimates are huge, like $600 billion tokenized by 2030, up from maybe $20 billion now.
Absolutely. This framework could really open the taps for institutional money. You see projects like Chainlink building compliance tools specifically targeting that huge pool of institutional capital, potentially over $100 trillion. They're tackling the hard stuff. Identity verification, compliance costs, which are massive, like $60 billion a year in North America alone. So if you're wondering where big money might flow, tokenized RWAs look like a prime destination.
So for you as a developer, trader, investor, keeping a close eye on RWAs in institutional stablecoin use is critical. Okay, let's shift gears to something everyone worries about, risk. The report doesn't ignore the dangers. What's the take on cybersecurity and illicit finance?
Right, it acknowledges the real risks. Smart contract bugs, keys getting stolen, hacks. The message is clear. Need strong cybersecurity, MFA, best practices. Basic hygiene, but essential. It's all about building that trust, that confidence, especially if you want institutions to feel comfortable.
And they're even looking way down the road, almost sci-fi territory with the quantum computing threat.
They are. It's a long-term threat, maybe 5–10 years out, but it's existential. Quantum computers could break today's encryption. Imagine widespread digital asset theft. That's why NIST, standardizing post-quantum cryptography, PQC, is so vital. Those FIPS standards they're developing, they're literally trying to future-proof the whole system.
And on the illicit finance side, there's this balancing act, right? Privacy versus transparency.
Yes, exactly. The report supports privacy for legitimate transactions on public chains, but it also makes sure regulated players' exchanges, custodians can do KYK-ML, identify customers, report suspicious stuff, and the data actually backs up progress. Illicit use is way down. Chainalysis says 0.14% in 2024, TRM Labs a bit higher at 0.42%, but still a tiny fraction. That narrative is important.
Yeah, changing the narrative from crypto is for criminals.
Definitely. And the DOJ seems to be shifting too. They disbanded that specific National Cryptocurrency Enforcement Team. The focus seems to be more on actual bad actors, less on, broad regulation by prosecution that might stifle innovation.
And they want more teamwork, right? Public-private partnerships.
Yes, encouraging use of FinCEN's info-sharing programs like 314A and B and this IVAN partnership for flagging illicit activity. Plus, crucially, they support your right to self-custody. But they also propose these digital asset-specific hold laws, basically a safe harbor for institutions to temporarily freeze suspect funds for investigation. It empowers good actors.
Interesting. And they even mention auditing the government's own crypto stash.
Yeah, directing an audit of government holdings and acknowledging the community wants transparency on the government's Bitcoin wallet. A nod to the community for sure.
Okay, last big section, but maybe the most practical for many listeners, taxes. This directly hits your bottom line, your gains and losses. The report admits clarity is desperately needed.
Absolutely. That push for tax clarity, especially around wash sales, staking, reporting, it's key for market maturity. It lets sophisticated investors actually plan, avoids nasty surprises, and just makes crypto feel more like other assets from a tax perspective.
For corporations, they're looking at the CMT, that corporate alternative minimum tax. How do unrealized crypto gains or losses fit in? Treasury and IRS are working on guidance. That's big for companies holding crypto.
And for individuals, the wash sale rule recommendation is key. Apply to all digital assets except payment stablecoins. That stops people from harvesting losses artificially, but doesn't mess up stablecoins used for payments. It's a smart distinction.
Yeah, that seems quite practical. What about staking and mining income? Still a headache for many.
Still a headache. Stakeholders are pushing hard for clearer rules, maybe even changing how it's timed. Right now, you recognize income at fair market value when you receive the rewards. That can be tough with constant small rewards and volatile prices. Needs clarification.
And reporting, like the 1099 DA form.
They're looking to make it easier for brokers, allowing electronic delivery of the 1099 DA, rather than forcing paper copies unless the customer agrees. It just acknowledges how these platforms already work mostly digitally. It reduces friction.
Okay, so pulling it all together after this deep dive, the headline seems to be a clear pro-innovation stance from the U.S., a big push for stablecoin laws, a firm no to CBDCs, and real efforts to bring TradFi in, manage risks, and clean up the tax mess.
Yeah, for you, the crypto expert listening, this report isn't just news. It's basically a strategic roadmap. It tells you where to point your attention and your capital.
So, on the learning side, really get into the weeds of proposed laws like the Genius Act and FEFI 21. Keep tabs on those NIST post-quantum standards discussions, and definitely track how the agencies SEC, CFTC, FDIC, OCC, Fed actually implement this new guidance. That's where policy hits reality.
Investing focus. Think hard about what stablecoin clarity means for DeFi opportunities. Look very closely at tokenized RWAs. That seems like a major growth area. Keep prioritizing security, cybersecurity, self-custody best practices. That never changes. And watch the tax guidance like a hawk, especially around staking, mining, and reporting. Clarity there directly affects your returns.
The big opportunities to watch, that flood of institutional money potentially coming in, easier banking for crypto businesses, big improvements in cross-border payments using stablecoins. The risks? Well, illicit activity is small, but cyber threats are constant. Vigilance with keys remains paramount. And remember, the U.S. is influential, but global regulation is still fragmented. Keep an eye on what other countries are doing, too.
So with the U.S. government now trying to write the rules proactively instead of just reacting, the big question for you isn't just what gets built next, it's who builds it, and maybe how fast can innovation align with this emerging clarity to really kickstart this potential golden age of crypto.